This graphic captures two key differences between defined contribution and defined benefit plans. The first column, the current employer or employee contributions. With a defined contribution plan, the simplicity is that this is defined by the agreement. In contrast with defined benefit plans, the employer has quite a bit of latitude in their current period contributions. The second issue is future benefits when the employee retires. With defined contribution, the employee bears the risk related to their investment decisions. If their investment decisions do not generate returns, there won't be much in the future for benefit payments to be made upon. Alternatively, with a defined benefit plan, this is the cash flow that is defined by the pension formula. So the employee has no risk related to those future benefit payments. For their employer, there are 3 annual entries required with defined benefit pension plans. The first is the computation of the annual expense. The journal entry to record this debits pension expense and credits the pension asset or liability account. So what this entry is doing is dropping the annual pension expense onto the income statement, and the credit is to a balance sheet account. The balance in this account can be an asset indicating a debit or an investment in the pension assets, or a liability. What this graphic shows is how the dollar amount of the annual pension expense accrual would be computed. The 5 possible components of pension expense are shown in the component column. Those 5 elements are the service cost, which would be expected to increase pension expense, interest on the pension liability, which would increase the expense. The expected return on the plan assets reduces pension expense, and these 3 will always be a part of the computation of pension expense, at least for a company whose defined benefit pension plan is more than a year old. The 4th and 5th items, the amortization of prior service cost and the amortization of net gains or losses, may or may not be present depending on the estimates made by management and whether or not they've changed any of their promises. The dollar amount computed, the total, then would be the amount of the adjusting journal entry that we talked about, which debits pension expense and credits that pension asset or liability. Next, we'll talk about each component of pension expense. The first component is service cost, and what this represents is the present value of the increase in the liability due to the employees working in the current year. To illustrate how service cost would be determined, we will use the following example. Don't worry, you won't be expected to go through this type of detailed computation, but this is here simply to illustrate how service cost is derived and to give you a feel about the 3 estimates of liability. So in this example, an employee goes to work for Matrix, and the time of employment, the person is 25 years old, and they're expected to work for 40 years before they retire at age 65. The benefit formula says that the employee's retirement benefit will be based on their salary in the last year of retirement, which is expected to be $200,000. They would have worked for 40 years, and the benefit plan defines that the value of 1 year of service is 1.5%. So at retirement, the employee is expected to receive benefits of $120,000 per year. For companies that offer their employees a defined benefit pension plan, they will have an actuary estimate the present value of the benefits earned during the year. So in this example, at the end of 2007, the employee's first year of service, the actuary estimates that that year of service has earned the employee additional $3,000 in pension benefits. That $3,000 is based on the expected salary of $200,000 in the year of retirement, This current year added 1 year of service, and each year of service is worth 1.5%. So the increase in pension benefits is $3,000. Another way of looking at that, it's the $120,000 expected benefit payment divided by 40 years of service. But service cost is actually the present value of the increase in the benefits. So the next step that the actuary would perform is to present value that increase in benefits of $3,000. So the $3,000 increase to benefits is multiplied by the present value factor, and that's 8.55948. That's the present value of an annuity. And remember, this would be a series of pension payments made over 15 years of the employee's retirement. And then we're going to multiply that by the present value of $1. So the present value of the increase to the service cost is $1,277. A second component of pension expense is the interest on the PBO. Interest is calculated based upon the liability balance in the PBO at the beginning of the year multiplied by the company's estimated settlement rate. Another component of pension expense is the expected return on plan assets. Remember that this element reduces pension expense. The reason for that is the company will be able to use the earnings on the plan assets to pay the benefits. So expected return, what reduces pension expense, is based on the plan assets measured at the beginning of the period and multiplied by the expected return. The final two elements that can be included in pension expense are amortization amounts. The first is the amortization of unrecognized prior service cost. Prior service cost results from a company providing additional benefits to their employees for work that's already been performed. So in that sense, it's a cost for prior service. What's going to happen is that the company will pull this into pension expense over a number of years. So pulling it into pension expense is the amortization process. There are two accounting methods that can be used for this amortization process. One is straight line amortization, which works much like straight line depreciation, and the other is years of service, which works somewhat like some of the years digits depreciation. The final possible component of pension expense is the amortization of unrecognized gains or losses. The gains and losses result from the actuarial estimate of the return on plan assets or the PBO being different from actual experience. So these are unrecognized gains or losses. We're going to net them together, and when the net amount becomes large enough that it goes beyond the corridor, the safe harbor, the company has to begin recognizing. So we'll apply what's called the corridor test and begin recognizing the net gains or losses when they exceed the corridor. And the corridor, the safe harbor, is 10% of whichever is larger, the pension liability, the PBO, or the plan assets. So at that point, the company would begin to amortize, pull into pension expense part of that amount in excess of the corridor. That would be recognized on a straight line basis. This graphic captures the gains and losses implicit in changes in the PBO or the plan assets. Good news when the PBO is lower than expected or when the return on the plan assets is more than was expected. Those result in gain situations. Alternatively, bad news is when the liability is more than what was expected or the return on the assets is less than what was expected. Those result in losses. Another decision and journal entry that a company with a defined benefit pension plan would have to make is how much cash or other assets to transfer into the pension assets. That decision is based upon balancing the minimum funding that's required by ERISA, which is a federal law related to employee benefits, and that establishes a floor or a minimum amount that must be provided. For most companies, the upper limit is set by tax law, which says this is the most you can deduct on the corporate tax return for assets set aside for the pension plan. So tax law effectively sets an upper limit. ERISA sets a lower limit. Most companies will be between those two amounts, and they'll decide how much to set aside based upon cash availability and their long-range funding requirements. A third entry that the employer would have to consider is to record the net funded status on the balance sheet. The difference between the best estimate of the pension liability, the PBO, and the plan assets is called the net funded status. If the pension plan has more assets set aside to fund it than liability claims, it's considered overfunded, and the net position would be an asset. If, on the other hand, the liability exceeds the assets, the pension plan is underfunded. GAAP requires that a company with a defined benefit pension plan reflect on its balance sheet the net funded status. And that requirement is the net, not the gross or the total liability or plan assets, but the difference between the two. Remember that the company will already have some pension asset or liability recorded on its balance sheet. When the entity recorded pension expense, they would have debited pension expense, credited that pension asset or liability, and that account is also used when the company makes an investment of cash or other assets into the pension assets. So some asset or liability already exists on the balance sheet. What GAAP says is that in total it has to reflect the net funded status. So the entity may have additional amounts to record. If so, they would do that by using other comprehensive income. As we compare GAAP to IFRS in accounting for pension plans, there's some slight terminology differences and some slight rule differences. As a whole, the accounting is fairly comparable between the two sets of standards.